welcome to the Deep Dive. Today, we're diving into something that, well, many of you already know is crucial, especially if you're building a business. Your personal credit score. It's often talked about, but we want to break it down into, really strategic, actionable steps.
Exactly. Because it's so much more than just a number, isn't it? It affects loans, partnerships, vendor terms.
Absolutely. And that's where things get interesting, how the personal financial picture connects directly to your entrepreneurial journey.
Right. So our mission today really is to help you turn that score from something that might feel like a constraint into a real asset for growth.
And we've got some fantastic insights, drawing heavily from the experience of Chris Lenz. His work in factoring gives him this unique perspective on how vital personal credit is, even for complex business financing.
Yeah, his view from that angle is really valuable. He sees it firsthand.
Definitely. So let's dive in. Understanding your credit score. Okay, so let's start with the basics, but maybe go a little deeper. What is a credit score fundamentally? What are these models trying to capture?
Well, at its heart, it's that three-digit number, usually 300 to 850, acting as a kind of snapshot of how reliable you seem as a borrower.
A snapshot of creditworthiness.
Precisely. And you mainly hear about FICO scores and Vantage score. They're the dominant players.
Right. Are they basically the same thing, or are there nuances we should know about?
They're similar, aiming for the same goal, predicting risk, but they can weigh things slightly differently. FICO is maybe historically more common for mortgages, auto loans. Vantage score is used widely too, especially by credit card issuers and for those free monitoring sites.
Okay.
But generally, if you score well on one, you'll likely score well on the other. They look at the same core ingredients.
So what are those key ingredients? What really moves the needle on that score?
Okay, there are 5 main factors. First, and this is the big one, payment history. That's about 35% of your score.
35%.
Yeah, it's huge. And, people often underestimate how long a single late payment can stick around. It can impact your report for up to 7 years.
7 years. That's significant.
It really is. Then second is amounts owed, or what's often called credit utilization. That's roughly 30%.
Okay, so how much of your available credit you're actually using at any given time?
Exactly. Third is the length of your credit history. That accounts for about 15%.
Makes sense. Longer track record, more data.
Right. Fourth is your credit mix, having different types of credit like cards and loans. That's about 10%.
Okay.
And finally, new credit inquiries. So how often you're applying for new credit, that's the last 10%.
That breakdown is super helpful. It really shows where the leverage points are, doesn't it?
Absolutely. Knowing those weights tells you exactly where to focus your energy. Why personal credit matters for business owners.
Now, let's connect this specifically to our listeners, the entrepreneurs, the founders. Why is personal credit so critical when you're running a business, even if the business has its own EIN and bank accounts?
Well, especially in the early stages, or even for established businesses seeking certain types of funding, lenders and suppliers often look through the business to you, the owner.
They want to see your track record.
Exactly. Your personal credit is seen as a direct reflection of your financial discipline, your reliability. If your business is new or maybe doesn't have a ton of assets yet, your personal creditworthiness often acts as a proxy.
It's like a character reference, but financial.
Kind of, yeah. How you manage your own money gives them clues about how you'll manage the business's finances, especially under pressure.
So, flipping that, what are the concrete advantages for a business owner who has cultivated a strong personal credit score? What doors does that open?
Oh, the benefits are pretty substantial. First off, easier loan approvals. And not just approval, but better terms. Lower interest rates on loans and lines of credit. That saves real money.
Big difference to the bottom line.
Huge. Also, it can seriously reduce the need for you to provide a personal guarantee for business debt.
Which is massive for protecting personal assets.
Absolutely critical. Then there are things like getting more favorable terms from suppliers, maybe longer payment windows, better pricing. And finally, it just opens up more options for better business credit cards, better banking services. Some premium business services still check personal credit.
Right. So it really translates into tangible flexibility and resilience for the business itself.
That's the perfect way to put it. Resilience. Step-by-step guide to improving your personal credit score.
Okay, this is where we get into the real nuts and bolts, the actionable stuff.
Yeah.
For someone listening who wants to actively improve their score, where's ground zero? What's step 1?
Step 1, and it's foundational. Check your credit reports for accuracy. Seriously, you get free ones from Equifax, Experian, and TransUnion via annualcreditreport.com.
And you really have to check all three, right? They don't always have the same information.
That's exactly right. They don't always align perfectly, so you need to pull all three and go through them carefully. This isn't just ticking a box, it's your first line of defense.
So when we're looking at these reports, what kind of errors are we actually hunting for? What should jump out?
You need to be meticulous. Look for incorrect personal details, obviously, but also accounts you don't recognize could be fraud, duplicate accounts, incorrect balances reported by creditors,
Okay.
outdated negative information that should have aged off, like old delinquencies, and crucially, check every single payment record listed. Errors there, like a payment marked late when it wasn't, are surprisingly common.
And those can really drag down your score unnecessarily.
Absolutely. Finding and fixing those is low-hanging fruit.
Okay, so let's say you find an error. What's the immediate next move? Step 2.
Step 2 is dispute those errors immediately. Don't wait. Each credit bureau has an online dispute process, which is usually the fastest.
Or you can send a letter.
You can, and sending it certified mail gives you a solid paper trail, which some people prefer. The key is providing clear documentation, supporting your claim account statements, cancel checks, whatever proves the information is wrong.
And the bureaus have to investigate.
Yes, they generally have 30 to 45 days to investigate your dispute and get back to you with the results. If they agree it's an error, they have to correct it and notify anyone who recently pulled your report.
Getting even one significant error fixed can make a real difference, can't it?
A huge difference, especially something like a wrongly reported late payment or a collection account that isn't yours.
All right, so reports are clean. What's the most critical ongoing habit? Step 3.
Step 3, make on-time payments your absolute top priority. Remember that 35% waiting, this is where it lives.
Consistency is key.
It's everything. Even one single payment reported 30 days late can significantly drop your score, and that negative mark can stay there for years.
Any practical tips for busy entrepreneurs to make sure this happens without fail? Life gets crazy.
Totally. Autopay is your friend, at least for the minimum payments on everything. Set calendar reminders a few days before due date.
Good buffer.
Yeah. And if cash flow gets tight, always make at least the minimum payment on time. That avoids the late payment ding. Keeping a small cushion in your checking account helps avoid overdrafts that could mess up autopay too.
Smart. Okay, that covers payment history. Next big chunk was credit utilization. What's the play there? Step 4.
Step 4, actively work to reduce your credit utilization. This is that ratio your current card balances divided by your total credit limits.
And the common advice is keep it below 30%.
Below 30% is the standard guideline, yes. But honestly, getting it below 10% is where you really start to see the best impact on your score.
Below 10%? That sounds pretty low. How does that work practically?
Well, say you have $10,000 in total credit limits across all your cards. You'd want to keep your total reported balances under $1,000.
Yeah.
Strategies. Pay your balance down before the statement closing date. That's the date the issuer usually reports your balance to the bureaus. So even if you use the card a lot, paying it down mid-cycle helps.
Yeah. So it's about the balance on that specific reporting date.
Exactly. You can also ask for credit limit increases on cards you already have, assuming you won't spend more. More available credit lowers your utilization percentage, even if the balance stays the same.
Right. Increases the denominator.
Precisely. And if needed, making multiple payments throughout the month can also keep that reported balance low. Lower utilization signals you're not reliant on credit, which lenders love.
Okay, what about applying for new credit? Entrepreneurs often need new lines for growth. How does that fit in? Step 5.
Step 5 is avoid opening too many new accounts all at once. Be strategic about it.
Because of the hard inquiries.
Right. Every time you apply for credit, it typically results in a hard inquiry on your report. 1 or 2 here and there isn't a big deal, but a whole bunch in a short period. That can make lenders nervous.
Signals maybe you're desperate for credit or taking on too much debt risk.
Exactly. It can temporarily dip your score by a few points per inquiry, but the bigger issue is the signal it sends.
So is there a smart way to handle applications, especially if you're, say, shopping for rates?
Yes. First, only apply when you actually need the credit. Don't just collect cards. Second, space out your applications if possible. And third, if you are rate shopping for a specific type of loan, like a mortgage or an auto loan, try to do all those applications within a short time frame, like 14 to 45 days.
Why is that?
Because the scoring models are designed to recognize rate shopping for those specific loan types. Multiple inquiries within that window are often treated as just a single inquiry, minimizing the impact on your score.
That's a really useful tip. Okay, what about the age of accounts? You mentioned length of credit history matters. Step 6.
Step 6, keep old credit accounts open even if you don't use them much.
Really? Why is that?
Because closing an old account does two potentially negative things. It reduces your average age of accounts, which is a scoring factor, and it lowers your overall available credit, which increases your credit utilization ratio.
Ah, okay. So unless it has a hefty annual fee you don't get value from, or it's somehow causing problems.
Exactly. Keep it open. Maybe use it for a small recurring charge once every few months and pay it off just to keep it active on your reports.
Got it. What about the mix of credit? Step 7.
Step 7 is try to diversify your credit mix over time. This just means showing you can handle different kinds of credit responsibly.
Like credit cards and installment loans.
Right. Revolving credit, like cards and installment loans, like a car loan or mortgage where you pay fixed amounts over time. You don't need to go out and get loans just for the sake of mix. That's not wise.
Okay.
But if you naturally acquire different types of credit through life and manage them well, it shows lenders a breadth of experience and responsibility, which can help your score.
Let's talk debt. If someone has existing debt they want to tackle, what's the strategic approach? Step 8.
Step 8 is pay down debt strategically. There are two main popular methods, and both work. It's about finding what motivates you.
Okay, what are they?
First is the snowball method. You list all your debts, smallest balance to largest, make minimum payments on everything except the smallest. Throw every extra dollar at that smallest debt until it's gone.
Then you take the money you were paying on that smallest one.
And roll it on to the next smallest, creating a bigger snowball payment. The wins come quickly, which builds amazing momentum and keeps you motivated.
I like that. What's the other one?
The avalanche method. Here, you list debts by interest rate, highest to lowest. Make minimum payments on all but the highest interest debt. Throw all extra money at that one.
So mathematically, this saves more money on interest over time.
Correct. It's mathematically optimal. But some people find it less motivating initially because the first debts to fall may be larger ones that take longer.
So it depends on your personality, need quick wins, or prefer long-term optimization.
Exactly. The best method is the one you'll actually stick with. Consistency is paramount.
All right, we're putting these habits in place. How do we keep track of progress and catch issues? Step 9.
Step 9. Monitor your credit regularly. You don't need to be obsessive, but checking in is smart.
How often, and what's the best way?
There are lots of free tools now. Credit Karma, NerdWallet, many banks and credit card companies offer free score tracking and report monitoring. Checking your score monthly and maybe pulling your full free reports every few months is a good rhythm.
And this helps you see if your efforts are working.
Yes, and it helps you spot any unexpected drops or signs of fraud, like accounts you didn't open really quickly. Early detection is key.
Okay, let's loop back to the business owner angle. Separating personal and business risk. What's step 10?
Step 10 is crucial for entrepreneurs. Actively leverage business credit to separate risk. Build credit in your company's name using its EN.
EN, Employer Identification Number. The business's equivalent of a social security number.
Exactly. You want lenders and suppliers looking at your business's creditworthiness, not just yours personally.
So how do you actually build that business credit? It's not automatic, is it?
Definitely not. You need to take specific steps. Get your EIN, first off. Open dedicated business bank accounts and, ideally, business credit cards that report to the business credit bureaus.
Not just any business card reports, right?
Sure, you need to check that. And importantly, work with suppliers or vendors who report your payment history to bureaus like Dun & Bradstreet, Experian Business, Equifax Business.
Dun & Bradstreet, they issue the DUNS number, right? That's a big one for business credit.
It is. Building a positive payment history with reporting vendors is key to establishing that separate business credit profile. This takes time, but it's vital for reducing personal liability.
What about people just starting out, maybe with thin credit files or those rebuilding? Are there specific tools? Step 11.
Yes. Step 11 is use personal credit building tools if you need them. There are products designed specifically for this.
Like what?
Secured credit cards are a common one. You put down a cash deposit, usually equal to your credit limit, which secures the card for the issuer. This makes them much easier to get approved for.
And you use it like a regular card. Build payment history.
Exactly. Then there are credit builder loans. These are small loans where the money you borrow is held in an account while you make payments. Once you've paid it off, the funds are released to you. It's purely to demonstrate payment ability.
Interesting. Kind of like forced savings that builds credit.
Sort of, yeah. And finally, becoming an authorized user on the account of someone with good long-standing credit like a parent or spouse can sometimes help, as their positive history might reflect on your report. But that comes with risks too if they mismanage the account.
Good point. Needs to be someone very trustworthy. Okay, those personal guarantees, again, they're so common in small business lending. Step 12 is about limiting them.
Step 12, limit personal guarantees whenever possible. Easier said than done sometimes, especially early on.
Right, lenders often require them.
They do. But as your business grows and establishes its own track record and creditworthiness, you gain more negotiating power.
So what can you do? Are there alternatives?
You can always ask if a personal guarantee is truly required, or if it can be limited, maybe capped at a certain amount, or set to expire after a period of timely payments.
Negotiate the terms.
Right. Look for lenders known for working with businesses without PGs, though they might have stricter requirements elsewhere. But the best long-term strategy is building that strong business credit profile we talked about. That's your ticket to eventually avoiding personal guarantees altogether.
Protecting your personal assets and score. Makes sense.
Beyond just credit accounts, what's another really foundational piece for protecting your credit overall?
Step 13, and this is just solid personal finance. Establish an emergency fund.
Ah, the safety net.
Exactly. Having 3 to 6 months worth of essential personal living expenses saved in an easily accessible account is crucial.
Why does that specifically protect your credit?
Because when unexpected things happen, a business downturn, a medical issue, job loss for a spouse, you won't be forced to skip bill payments or rack up huge credit card debt just to survive.
It buys you time and options.
Precisely. It prevents short-term problems from becoming long-term credit damage. Automate savings, even small amounts, into that fund. It protects your credit and your peace of mind.
Okay, final step. What if someone feels truly overwhelmed by their debt or credit situation? Step 14.
Step 14 is, don't be afraid to work with a reputable credit counselor if needed.
Who are these counselors and what do they do?
Look for nonprofit agencies accredited by organizations like the NFCC National Foundation for Credit Counseling or the FCAA Financial Counseling Association of America.
Okay, reputable sources.
Yes. They can help you create a realistic budget, develop a debt management plan where they might negotiate lower interest rates with your creditors, and provide education on managing finances better going forward.
So it's not about quick fixes, but sustainable solutions.
Exactly. If you're really struggling, professional guidance can be incredibly valuable. Common pitfalls to avoid and time to loads. All right, we've covered a lot of do's.
Yep.
What are the don'ts? What are the big pitfalls people stumble into when trying to fix their credit?
Good question. Avoiding mistakes is just as important. Some common ones are ignoring due dates. We hammered this, but it's the #1 killer. Set up those alerts and autopays. Closing old credit cards. We discussed why this hurts your average age and utilization. Think twice.
Right.
Applying for too much credit too fast. Those hard inquiries add up and look risky. Be selective. Mixing personal and business expenses and using personal credit for business risks. Keep things separate as much as possible. Build that business credit. And finally, relying too heavily on just one type of credit. A healthy mix looks better over time.
This feels like a significant undertaking. It's not overnight. For listeners putting in the work, how long does it realistically take to see tangible results?
That's a really important expectation to set. Improving credit is definitely a marathon, not a sprint.
No magic bullet.
No. But you can see progress at different stages. You might see some immediate improvements, maybe within 1 to 2 months, especially if you correct errors on your reports or pay down a big chunk of credit card debt, lowering utilization quickly.
Okay, so quick wins are possible.
Yes. Then you'll likely see noticeable increases over 3 to 6 months of consistent on-time payments and keeping that utilization low. Habits start to pay off.
Building that positive track record.
Exactly. And substantial, lasting growth usually takes 6 to 18 months or even longer. This is where the length of your positive history really builds, and older negative items gradually have less impact or fall off entirely.
So patience and persistence are key.
Absolutely. Stick with the good habits, monitor your progress, and the score will improve over time. Outro.
So wrapping this all up, what's the big takeaway for our listeners, especially those leading businesses?
I think the core message is that your personal credit score as an entrepreneur, it's really far more than just, a number banks look at. It's a reflection of your financial stewardship, your planning, your resilience. And in the business world, where access to capital and favorable terms can literally make or break you, strong personal credit becomes this incredibly valuable strategic asset.
Right. It unlocks doors. By following these steps we've discussed, checking reports, paying on time, managing utilization, separating business and personal finances, you're essentially taking control of your financial narrative.
You really are.
It's about getting access to better tools, better terms, and ultimately building your business on a much stronger, more confident foundation with fewer personal vulnerabilities.
Well said. Investing in your personal credit truly is an investment in your business's future potential and its long-term health.
Couldn't agree more. And that brings us to our final thought for you today. Reflecting on everything we've unpacked, what's just one small, manageable step you could commit to taking, maybe even today or this week, to start improving or strengthening your personal credit marathon?
Just one thing to get started.
Exactly. Pick one, start now, stay disciplined, and watch how that focused effort helps your financial credibility flourish over time.